Well, thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. A lot of conversations with Saurabh Mukherjea tend to revolve around investing, which almost seems, in his own words, like paint going dry, like a conversation which can be almost similar to the previous one because his investing thesis is so much about the long term. And which is why the conversation today, we requested him to talk about something which could be slightly different. In that, too, we are going to talk about, of course, how ignoring the short-term noise might actually help create long wealth for you. But viewers, I urge you all to think about this, that two facets of investing. One is exciting and one is simple and boring. Maybe the simple and boring actually leads to creating higher wealth. And if you're in this business for creating wealth, why do you want to have something which is for the necessity of it is exciting, but may not necessarily get you tremendous wealth? But the key point, Saurabh Mukherjea, that I want to talk to you about today is that if we are looking at a period of rising GDP growth in the country and arguably the world, I would urge you to tell us, how would you think one can create wealth out there? Good morning, and thank you so much for joining us today, Saurabh.
No, my pleasure. Thanks, Dheeraj. Good to be here and I'm privileged to be on Talking Point. Look, I think first off, I think we need to enjoy the fact that we're in a period of rising GDP growth. It's been a rough few years in our country. For I think a lot of people watching, it's been a rough few months. So first off, leaving aside how much money we can make in this, let's enjoy the fact that this the current year that we are living in will probably be the strongest year for global GDP growth, I think in 15, 16 years, right, for all the major economies. And as we saw in fourth quarter FY21, the Indian economy too has picked up steam very nicely. And whilst April, May might be a small aberration, it's pretty clear in June, again, things are revving up. Things are revving up quite nicely. Now the question then is, how do you and I make money in this climate, right? And the temptation in a period of rising GDP growth in our country, the temptation is to go and buy steel and construction and real estate stocks and cement and metals and mining. It's a very kind of reflex reaction, right? It's a reaction that people need to watch out for because, as we can see, inflation is roaring through as well. So as growth picks up across the world, CPI inflation and WPI, not just in India, globally, we're seeing some of the highest inflation prints in a generation. And I don't think they'll go away slowly. They'll go away quickly. Because of the amount of pent-up demand, because of the amount of monetary and fiscal stimulus in the system, we will have very strong growth for the next couple of years, and we are likely to have high inflation. In such a climate, if you and I don't invest in companies with very strong pricing power, companies with very strong franchises, then input cost inflation will wipe out the benefits of strong top-line growth. I think strong top-line growth will become the norm. We will see that even in the 1Q results, we'll see that to some extent. We'll see that more forcefully in the 2Q results, strong top-line growth roaring through as the planet goes through a supercharged recovery. But if you get carried away by the recovery and you don't invest in franchises with enormous pricing power, then the problem is the top line won't translate into bottom line. Inflation will erode the gains. So one of the things we've done for a number of years, and as you rightfully said, it is boring, but it makes us a great deal of money. So we stay the courses. We look for franchises which have very strong pricing power, dominant franchises, which are able to pass on the input cost hike to their customers, thus protect their margins, thus allow you and me as shareholders to get the benefits of this roaring economic recovery.
Awesome. So just a question to that, and maybe dwells on a point of noise as well, though I don't quite know, and I don't think too many people would say that they know it completely well. But does the narrative around higher inflation, therefore subsequently higher yields, maybe some bit of tapering, some bit of interest rate hikes, and for the first time in many meets, Jerome Powell did hint towards higher inflation, so on and so forth. Would that upset the apple cart for equities and large, and therefore the follow-up to that is, should one be wary about buying high quality franchises which are trading at very high valuations, because there could be multiple derating as well, not just earnings. Actually, earnings may not come off, but there could be multiple derating because of the mood in the market.
Sure. So I think the good thing is, Neeraj, we don't have to speculate on this subject. This has happened twice in the last 20 years. So 2004 the Fed started hiking. So 2003, the economic recovery began globally, India included. 2004, the Fed started hiking. And believe it or not, the Fed, the ECB, the Bank of England kept hiking all the way through to December '07, right? In fact, they were ridiculed later on for hiking in December '07 when September '08, the world fell apart. But the more salient point for your and my conversation is '04 to '07, the central banks kept hiking. We had the greatest bull market in this century in those 4 years, right? We had another go. So 2013 summer, the Fed started the tapering, and that's the name, taper tantrum. We went through there was a bit of a lull in the global bull market in 2013, but by 2014, investors figured out that the underlying economy is strong enough, and again from 2014 basically through to 2019, we had pretty solid global growth and equity markets, even though the Fed gradually took their foot off the pedal. So the point I'm making is, it is but normal that once economic growth starts normalizing, regardless of what the Fed does or the RBI does, the bond market itself starts raising the cost of money, and bull markets continue, driven by the economic growth. It'll be no different this time, right? In fact, I said 6 months ago to our clients and in the media that I said back in December that it was pretty evident that inflation would come through, global growth would come through, and therefore over the next 2 to 3 years, the cost of money should start rising. Now, this bizarre point people come up with, right, that interest rates will go up and PE comes down. Obviously, it has got no rational support. So again, harking back '04 to '08, people who are watching this can go back and check the data out. You had high PE multiples '04 to '08. You had high PE multiples before '04. You had high PE multiples after '08. Right? It's got nothing to do with interest rates. And similarly, you had high PE multiples before the taper tantrum of June 2013, and you've had high PE multiples after the taper tantrum. So these are bizarre psychological traps, and this is why I tell people stay away from noise. These are largely invented stories. And I used to also do it as a broker, I'll be honest. These are very easy stories to build, and you can get people to trade endlessly on these ruses. And they're easy to spin, and it makes people trade, so why not do it as a broker? But you as an investor, I as an investor, if we fall for these stories, we just end up missing out on the fundamental story. The fundamental story is we're in the midst of a global economic recovery. You've got 2, if you're lucky, perhaps 4 years ahead of us of strong growth. Invest in superb franchises who can benefit from the growth without giving up their margins to inflation.
Okay. Okay, then let me try and rephrase my question. Assuming that the script, and we are none wiser to say that it'll be different, but assuming that the script stays the same this time around as well, do you get tempted, Saurabh, to change the composition or the weightages of the investment hypothesis or the investment bets that you've taken, simply because the nature of the recovery in a post-pandemic world might be slightly different, or the valuation multiples at which you are buying some of the franchisees are slightly different? So no doubt, let's assume you are betting on 5 franchises, all 5 will hopefully do well, but the 5 will give you different returns simply because of the point of entries, right? So that's my question to you, really. How do you now segregate your investment bets?
So this point of entry stuff is very interesting. So again, the data comes handy. So if you look at the first decade of this century, the 10 years ending December 2010, right? You can see the data. You'll see that 28 companies created 80% of the wealth in the Nifty, right? So we'll take the wealth creation in the first decade of the century. More than half the Nifty joined the wealth creation journey, right? Let me put it like that. If you look at the second decade of the century, the 10 years ending December 2020, barely 15 companies drove 80% of the wealth creation in the Nifty, right? So the point I'm driving at is the nature of the change in our country. Our country is getting networked. We were a hitherto fragmented economy. Through the last 10 years, highways, low-cost airlines, broadband, mobile phones, GST is slamming the country together. As we do that, a very narrow set of really well-run companies across sectors, a really small set, 15 in all, 15 companies are driving 80% of the wealth creation in the market.
Sure.
Now, in a world which is as polarized as that, and I suspect the 10 years, the decade we have entered, Neeraj, will be even more polarized. I think that 15 potentially goes to 11, 12 in this decade, right? In a world which is as polarized as that, where the benefits of technological progress are being appropriated by a narrow set of really smart management teams, if you and I, in that sort of world, are spending our time second guessing points of entry, then I think honestly we will need divine intervention to compound our wealth, right? The homework exercise already is pretty tough for us. Data is showing us barely a dozen, perhaps a dozen and a half stocks, Neeraj, will generate wealth in the decade we've entered. And I think every sort of iota of intelligence we have should focus on identifying those dozen and a half stocks. The point of entry, I would submit to you, doesn't matter so much.
But okay, can I not counter that really, but just do a counter argument that Saurabh, that you identified a bunch of names which you've thankfully very candidly spoken about, released in newsletters which are open for all. By the way, Marcellus.in viewers is a fabulous site to go out and read some of these. But my point is, Saurabh, in the peak of the fear in 2020, a very high quality Bajaj Finance went down to as low as 1800, and that's my argument about the point of entry. So hypothetically, if you were equally invested in a high quality Asian Paints, high quality Bajaj Finance, but if you were able to, I'm just saying, found that the valuation destruction at that point of time in Bajaj Finance was so severe that you can take advantage of that. You made 3x returns versus in Asian Paints when you probably made 2x returns.
So if I look at our portfolio, right, which has Asian Paints, as you're rightly saying.
Which is why I use those two examples.
It has Bajaj Finance, it has HDFC Bank. So January, February, March 2020, COVID ripped through the Indian market. The market corrected, I think, 31%, Jan, Feb, March 2020. Our portfolio corrected 13%, right? Now, you're absolutely right? So the way we run our portfolio is every stock has a weight as per the comparative advantage. So 1st Jan 2020, Bajaj Finance's weight in our portfolio was 9%, right? That's the ideal weight that we want Bajaj Finance to be. The January, February, March 2020 panic made the 9.3. So by 31st March, Bajaj Finance was all of 3% of our portfolios. So through April, when the rest of the world was saying, my God, it's all over for Bajaj Finance, countries now in hello, we were all in lockdown, we were all sitting at home. Our analysts did more work on Bajaj Finance, and our conclusion was, in April 2020, Bajaj Finance is an even stronger franchise than it was on 1st January 2020. So I remember last week of April 2020, we told our trader that Bajaj Finance should be 9% of the portfolio, right? It was 9%. So I remember first week of May 2020, our trader put the trades on and we tripled our position in Bajaj Finance, right? Now, what we are trying to do, right? Somebody might say we are buying Bajaj Finance as the bottom, right? But remember, to buy Bajaj Finance, we need money, right? Where will we get if you're tripling on Bajaj Finance, where will we get the Bajaj Finance, where will we get the money? So the answer came from the reverse, right? So January, February, March 2020, the pharma stocks in our portfolio more than doubled, because for some reason people in our country thought that because of COVID, a lot of medicines will sell. So the two pharma stocks, Divi's and Abbott in our portfolio, went from being to cumulatively 9% on 1st Jan, they became 18% by end March 2020. So we asked our pharma analysts that, look, are these companies so good now that they merit an 18% weightage? So the pharma team turned around and said, no, 18 isn't merited, 11 is merited. So we took 7% out of the pharma stocks, and 6 went to Bajaj, and I think 1 went to HDFC Bank, or 2 went to HDFC Bank. So the point I'm driving, and the point we keep trying to communicate to people, is price has no bearing one way or the other, right? You have to drive your position sizing basis the strength of the franchise. Bajaj Finance's weight on 1st January 2020 wasn't 9% because it was expensive or because it was cheap, but because it was a super franchise. Divi's and Abbott's weight cumulatively on 1st Jan 2020 wasn't 9% because it was expensive or cheap, but because they were super franchises. The two went in different directions in Jan, Feb, March 2020. In April, we did our work and we realigned the portfolios to what we felt was reality. Our reality is not influenced by the stock market. What the stock price tells you isn't the reality of the franchise. Reality is what your research tells you about the strength of the franchise.
Okay, thanks for explaining that. So now tell us, and I'll get back. I mean, important discussion, but we got digressed a bit. I digressed it a bit. How do you take advantage of a rising GDP scenario then? Do you increase weightages or exposure to certain segments of the market versus others? How do you do it?
So there's two things that we have done. One is July last year, we launched a fund called Kings of Capital, a PMS called Kings of Capital, which was intended to buy the best lenders, the best NBFCs, the best asset managers, the best insurers, the best brokers at very attractive valuations and capitalize on a 3-4 year economic recovery. So Kings of Capital now has, I think, around 500 odd crores in it. We are compounding earnings. The portfolio is compounded at 30%, but let's focus on earnings compounding because that's the reality. Earnings are compounding at around 25%, which was the expectation, and we are super optimistic. In the next 3-4 years, the sorts of lenders we have invested in, HDFC Bank, Kotak, Bajaj Finance, Axis Bank, EU Finance, we can see that these lenders are far, far, far better capitalized than the rest of the banking system, in spite of provisioning 6 times more than the top 3 PSU banks. So in spite of provisioning 6 times more than the top 3 PSU banks, which together account for, by the way, 45% of loans outstanding in India, right? Our lenders have 6 times higher provisions, and yet they have almost twice the tier 1 ratio. So to our mind, it's relatively straightforward. The economic recovery will help our lenders. The other bit of the portfolio is the savings play, right? So the RBI has repeatedly pointed out in the last 4 years that Indians are investing 95% of household savings in physical assets. The RBI has said this is without precedent anywhere in the world. No other country has a skew like this. And to our mind, the events of the last 3-4 years, right, Demon, GST, COVID, means that it's inevitable that the sort of people watching this program, your and my friends and family, will tilt away from physical towards financial. 5% of household wealth is financial savings. That's around $500 billion. Our data shows, this is basis AMFI, IRDA, SEBI data, this number is rising at 1% a year. 5 is becoming 6 in a year's time, 6 is becoming 7. Our total household wealth is 10 trillion. 1% is 10 trillion is $100 billion a year. So Indian household savings are growing at $100 billion a year, which means the market for household savings easily quadruples in the next 10 years. So we are investing in the best life insurer that the country has, the best general insurer / health insurer the country has, the strongest asset manager that is listed, the strongest broker that is listed. So distinct from the lending play in a way is the obvious play on a recovery. We believe an equally powerful play on the next 3-4 years recovery is the financialization of savings, and Kings of Capital is our central vehicle to play this. Our other portfolios, Little Champs and Consistent Compounders too have financials, and financials accounts for a good 35-40% of all of our portfolios, and those weights have stayed high through the last 12-13 months, and will probably stay high for the rest of the recovery. So I would submit to the people watching this, financial should be a central vehicle to play the recovery. A more interesting play on the post-COVID world is the rise of specialty chemicals in India, because India looks like it's becoming the world's specialty chemicals hub. We were the pharma hub. We will stay the pharma hub. But the next leg, which is playing out, is Western chemical companies don't want to make the stuff in the West due to environmental reasons. They were hitherto focused entirely on China. After the Wuhan scare, they are now diversifying their China exposure and using India as a sourcing hub. This is going to rise more and more. Environmental restrictions in China have tightened, which means Western companies find it that much easier to ship to India. And India looks like it is becoming and will become over the next 10 years a major specialty chemicals hub. And we have built in our Little Champs portfolios large positions in well-run specialty chemicals companies where the chemistry is complex, often hazardous. Getting environmental clearances to set up the plants isn't easy. And getting credible clients, large pharma companies, large chemical companies isn't easy because the client needs to have faith in your chemistry skills to deliver large quantities of hazardous chemicals on time. So we have built positions in firms like alkyl amines, firms like GMM Fogler, and this is an area where I think there'll be more money to be made, and this is an area where we're doing more work. Right. So what happened in pharmaceuticals around the turn of the century, and in Indian IT over the last 30 years, I think the same story looks highly likely to play out in specialty chemicals in this global economic recovery.
Okay, so I reckon that's the way to play the GDP recovery, not just in India, but globally as well. Now, Saurabh, the counter question, and not to this argument, but just in order to figure out how do you, you've spoken about how do you choose companies, right? Let's talk about how do you weed out the mistakes, and most importantly, how do you think this advent of ESG actually aids your decision-making process? Because clean accounting, everything is probably the forefront of you, not just right now, but even in the ambit days, you used to give out this good and clean portfolio, etc. So
this has been a very interesting journey for us. So when I came to India 13 years ago, people used to laugh at us saying, who wants clean? We just want to make money, right? And I remember being told even 6-7 years ago by a lot of people that, clean though is for wimps. We are here to make money, right? Real make money, wimps look for clean stuff. The world has changed. Everybody now has realized that if you invest in companies which pollute the world, which abuse human rights, which abuse their workers, which cook their books, right? It's a disaster at every level. It's not just a question of whether you make money or not. If you're investing in companies which are abusing their workers, abusing human rights, or cooking their books, and often, very interestingly, all this cocktail comes together. So we are seeing both in the overseas institutional clients that we have and in the Indian high net worth market a very strong focus. People say, you're in my social strata who are working hard for their money. They're very clear that don't invest my money with crooks. Don't invest my money with promoters who abuse human rights, abuse their workforce, cook their books, right? It's a very, very clear mandate coming through from salaried Indians who are saying, I have worked hard for my money. I don't want my money to be invested in crooked companies. So the layer that we've done a lot of work on over the last many years is the forensic accounting layer, right? Probing very carefully through many different layers. Is this company doing funny things with its accounts, right? Is the auditor complicit in the company doing funny things in its accounts, right? And it's almost in a way, it's a never-ending thing, because even with clean companies, unfortunately, we have seen them turn rogue. We have seen clean companies turn rogue, and the promoter putting his hand in the cookie jar every now and then. So we stay vigilant. We continue using forensic accounting techniques, which come from the best auditors in our country. I think India has a superb chartered accountancy qualification. We are major beneficiaries of that. So we're publishing a book in late July on this called Diamonds in the Dust. The first 100 pages of the book is non-stop forensic accounting case studies using real companies and giving detailed case studies, how reading annual reports carefully allowed us to detect naughtiness in the accounts way before the rest of the market wised up to it. The second 100 pages of Diamonds in the Dust is the diamonds piece, where, again, reading annual reports carefully helps you understand that this is an exceptional franchise that the market is misunderstanding. And honestly, that's the work which makes us a lot of money rather than getting lost in the noise. You do the detailed work on 10, 15 years of annual reports. We've created a battery of forensic accounting ratios. We look carefully at the audit disclaimer. We take the audit partner's number, we check them out and say, is this audit partner, does he have a good track record, or has he been associated with naughty companies in the past? And on the flip side, great franchises, their annual reports tend to have a certain consistency. Their annual reports tend to be understated. And the deeper you go into the notes to the accounts, the greater you realize the strength of the franchise. In fact, you realize that with many great companies, the stated earnings understate the strength of the franchise. Just off the top of my head, if I look at alkyl amines, consistently they invested 2% of revenues in R&D and they expensed it out. Right, 2% of revenues in R&D for any cap, small cap or large cap, was a big deal. Right, you're reducing your operating margins by that amount. Their rival didn't invest in R&D. Right, Alkyl's R&D strength now means that in the last 10 years, their SKUs have quadrupled. right? Now, that is the new India, where you're investing in companies which are fundamentally a play on science, on technology, on intellectual property, rather than the Purana style, the old style, cement and concrete and steel and construction and real estate. That has its play, but you and I are not going to make a lot of wealth from investing in that old world. The world that lies ahead of us is the world where, regardless of market cap, we're investing in companies whose brains, whose technology allow us to benefit from the next 10 years.
Okay, Saurabh, so let me wrap up this conversation with a question to you. You would therefore say that not just short-term noise in the market, but if there is short-term underperformance as well from quality franchises, because they don't need to rise every day, you reckon over a longer period of time, they will more than make up for it?
There is no question of making up for it needed. What I'm getting at is that great franchises continue delivering results consistently, right? What we are not that fussed on in Marcellus is what is the share price doing, right? HDFC Bank share price barely did anything in the 2 years running up to Aditya Puriji's retirement. Were we losing sleep about it? We weren't. Our focus was on the compounding of the franchise, of the earnings, and that it was coming through nicely. We calmly stayed invested, right? So the point I keep making to people is, do not look at the share price. It tells you nothing. What we need to do is focus on the franchise. If the franchise is continuing to compound, sit tight, maintain your exposure at a high level, and ride with it. If for some reason the stock corrects needlessly, you load up even more on it. The Bajaj Finance example that we discussed.
How easy it is to communicate this to your investors who put in money, or some set of investors who put in money not just because they agree with your thesis, but because they want to see at some point of time annual returns. And what if there is a period of underperformance from your end 1 year, wherein the street, because they are investing in companies which will rebound very smartly, are making more money compared to you?
So, Neeraj, in a way, birds of a feather flock together, right? Our style of communication, our style of investing is what it is. We're very vocal about it. And I suppose, therefore, we've attracted people who really don't look at Nifty ka kya performance aaya. It also helps that we've had years like the year ending March 2020, where the Nifty was down 25% and we were up 9%. Right? Once an investor sees that, he never forgets that here are a group of people who are able to hold it together when all else disintegrates. Yes, in the year ending March 21, after that stellar show, 33% outperformance in year ending March 20, the year ending March 21, I think we underperformed the Nifty by 5%, right? We were up 51 or 52. The Nifty was up 56. I don't think anybody called up to say, can I have my money back because you underperformed by 5%. If anybody did, we would obviously remind them, so did you see year ending March 22, 33%? But more fundamentally, it goes back to the sort of clients we're attracting. We're attracting hardworking people who are affluent salaried professionals, SME owners, in some cases owners of large companies, and they understand the nature of India. That if you're not conservative in how you invest, if you don't look out for clean, high quality franchises, your money honestly is at risk. And therefore they gravitate towards, without Marcellus, they naturally gravitate towards the HDFC Bank, Kotak Bank, Asian Paints, Pidilite type story. Right? We are just a medium for them to access that story. Those companies have predated us by decades, and I'm so glad they did, because they've given us a way to build a franchise using the monies of hardworking people.
Cheers to that, Saurabh, and I hope you keep up the good work. Thank you so much.
Thanks.
And much appreciate you taking the time out and speaking to us today.
Thank you. Thanks a lot. Take care. Bye.
The pleasure was ours. Viewers, thanks for tuning in to this what was for me a really wonderful conversation.